Welcome to the 17th edition of U Credit CLC webinar series. U Credit webinar is part of CLC Corporate Social Responsibility Initiative designed to educate Nigerians and financial institutions and other stakeholders on the issue of credit and its impact. So today's webinar theme is improving credit portfolio performance using data-driven insights, and we are glad to have you join us this morning or afternoon or evening, depending on where you are joining from. My name is Joshua Oluwashayo. I will be the moderator for today's webinar. Please be advised that we are recording this section and also streaming live on our various social media platforms. The recording will be made available after this webinar so that you can actually view the replay. Kindly use the question and answer box for your questions. Today promises to be an impactful section, and we are honored to have you join us in this morning's section. Joining us as the guest speaker this morning is the Executive Director, Risk and Compliance for First City Monument Bank, Mrs. Oluwatoyin Olaiya. And we also have with us the Chief Host and Speaker, who is the MD and CEO of CLC Credit Bureau, Dr. Tunde Popola. We also have in our midst Mr. Oyetunde Oyediji, the Chief Risk Officer of Advanced Lafayette Microfinance Bank. And last but not least, we have with us Mr. Isaiah Yede, the Head of Automation in CLC Credit Bureau. So in this webinar, we'll have the MD of CLC, that's Dr. Tunde Popola, give his welcome address. Then thereafter, we'll have the keynote speech from the ED, that's Executive Director of Risk and Compliance at First City Monument Bank. Then we'll go into the panel section before we now move to the Q&A section. So briefly, I would like to introduce the guest speaker and the panelists to us. So the first speaker we have with us, our guest speaker, is Mrs. Toyin Olaiya. Is the Executive Director, Risk and Compliance at FCMB, where she works to ensure the bank manages risk responsibly and remains true to its values, enabling it to support its customers and communities over the long term. She joined FCMB in 2016 as Chief Risk Officer and strengthened the bank's enterprise risk management framework, drawing on disciplined risk governance, clear policies, and strong oversight of credit and regulatory compliance to improve asset quality and reinforce the culture of accountability across the institution. With more than 35 years of experience spanning audit, risk management, internal control, and compliance, Mrs. Olaiya has built a career defined by prudence, leadership, professional integrity, and careful balance between growth and responsible risk management. She began as an auditor at Peak Mawick, Ani Ogunde & Co., the firm that later evolved into KPMG Nigeria, and went on to serve in other financial institutions before joining FCMB. In June 2021, she was appointed an Executive Director at FCMB. Mrs. Olaiya holds a bachelor's degree in accounting from the University of Ife, now Obafemi Awolowo University, and is a fellow of the Institute of Chartered Accountants of Nigeria. She's also a graduate of Chief Risk Officer Certificate Program at Ernst College, Carnegie Mellon University in Pittsburgh, Pennsylvania. She continues to deepen her expertise through executive leadership and risk management programs in Nigeria and abroad, advancing strong governance and sound banking practices throughout her work. Then we have the Chief Host and Speaker, Dr. Ahmed Popola. Dr. Tunde Popola is the founding MD CEO of CLC Credit Bureau. That is Nigeria's largest credit bureau, where he has consistently championed data-driven solutions for access to credit and sustainable Nigerian economic growth. And he holds several awards and recognition. Before joining CLC as the founding CEO, he was the founding CEO of the Abuja Enterprise Agency, where he championed entrepreneurship, youth and women's empowerment, notably enabling Nigerian students to win global students for the advancement of global entrepreneurship. World Cup in 2007, 2008, and 2009. His 14 years in banking saw him rise to the position of CFO, general manager at a publicly listed bank. Also with us at the panel as a panelist is Mr. Oyediji Oyetunji. Mr. Oyediji Oyetunji brings years of experience in the microfinance industry and is the current CRO of Advanced Lafayette Microfinance Bank. And last but not the least is Mr. Isaiah Iyede. Mr. Isaiah is the head of digital and automation at CRC Credit Bureau. At this junction, we want to welcome our MD, the CEO of CRC Credit Bureau, for his introductory presentation. Thank you. Thank you for listening, everyone.
Thank you so much, Joshua, for the kind introductions. Good morning, everyone. It's a pleasure to have you with us this morning. Let me start on a note of appreciation to our keynote speaker this morning, Mrs. Toyin Olaiya, my director, my boss. Good morning, madam. It's nice to have you here with us on this beautiful morning. And then I'm very happy to have Mr. Oyediji Oyetunji, the CRO of Advanced Lafayette, one of our core customers. They pay our salaries here in CRC, so just like FCMB does. So we're happy to have you here, and we are very grateful that you are joining us as a panelist this morning. I'm glad also to have my colleague in the office, Isaiah Iyede, our head of automations and product development, who also joining us as a panelist this morning, and distinguished ladies and gentlemen who have joined us from all parts of the world. So today's webinar, we count it as extremely very important. The topic is improving credit portfolio performance through data-driven insights. As we know, CRC is all about data, and we believe so much in data and what it can do. People say data is the new oil, and it's not far from the truth. So, but what use is a data that is not put to quality use, to good use? So today we're going to be discussing how to improve portfolio performance through data-driven insights. My job is just to welcome you and to introduce us to the topic of discussion today. We have an erudite personality in the name of Mrs. Toyin Olaiya, who's going to do justice to the topic. But clearly, as we can see around us in Nigeria in particular, we are seeing a credit environment that's becoming very challenging, very complex. And every institution needs to be able to see what they can do to lend, not only to lend, but also to be able to manage the credits that they have lent. In just a few weeks ago, the CBN decided that the forbearance that was given during COVID should be taken off, and we saw immediate rise of NPL to around 8% from around 4%, 5% that it was before. So, which means that there are inherent, issues on some of the loans that are being carried by some of the banks. We also saw that some of them are not even able to pay dividend this year. One of the reasons being that particular issue. So when you have this kind of thing, what it means is that the issue of non-performing loans is still a major issue with us. So this webinar is put together to examine how data-driven insights can be leveraged by financial institutions and lenders generally to manage their portfolio, their credit portfolio, so that we can have reduced incidence of non-performing loans. We can increase portfolio allocation and so many other benefits that really come with that. And so this is not a webinar that's like for the entire public like that. It's basically designed for credit professionals, risk managers, portfolio managers, and other senior executives who are interested in how data can really be used to drive, credit and portfolio management. Our work in CRC and as a bureau is well cut out for us. We collect data from various institutions, banks, non-bank institutions, utilities everywhere, where we have credit data or data on account of, services rendered for which payment is received later. And we, turn all of that into, products and services that come basically in forms of credit information, in form of credit scoring solution, and in form of portfolio monitoring, which is the core of what we are talking about today. This is how a bureau runs. For those of us who might not be too well conversant with CRC Credit Bureau, we are the largest credit bureau in Sub-Saharan Africa, and obviously in Nigeria. We are owned by a consortium of 10 banks, and we've done Ambrashit, one of the leading risk management solution provider in the world. And we've been around since 2009 when we were licensed. And so with our 17 years of experience in data, in credit data, we think that we have things to offer. And as a big bureau, we service over 2,300 institutions. This is what at May, and the number keeps on growing. Our database as at that May had risen to about 60 million data subject, unique count of data subject, made up of 58 million individuals and about 2 million of commercial entities or businesses. And of course, the unique data or loan facility that we had at that time was about 165 million. Today is almost a month end. By next week, we'll know what the additional numbers have joined, which means this number I'm giving to you now will have increased both in number of data subjects and in number of facility counts. And we do collect data. The 2,300 institutions that our customers range from banks, microfinance bank, commercial banks, or deposit money banks, non-financial institutions, insurance, telcos, discos, leasing companies, cooperative societies, the specialized bank, the fintechs and the micro lenders are very, very, very present, very highly present in as part of these 2,300 institutions that use CRC Credit Bureau. Our products cover the entire spectrum of lending or credit. We have products that support customer, sourcing or marketing of customers to getting new customers. We have products that speak to profiling of customers when they do requests for loans. And we have those that speak to monitoring of credit once those facilities have been granted. And the final set of products that we have speak to collections management in case there's default. And of course, we have a very strong financial education center that also caters to training on credit and risk management. Now, just to give you an idea of each, products that speak to the topic we are discussing today, which is on managing portfolio. We have about 8 of them that any institution can leverage upon to increase monitoring of products, monitoring of credit. Let me just speak to 2 of them. The first one, portfolio monitoring, and then risk calculator. The others are, because of time, maybe when we do have enough time, I'll speak to them on that again. The portfolio monitoring monitoring report, which we normally call PMR, is a product that speaks to opportunity to have, it's like a dashboard that speaks to opportunity to see what your customers as an institution, what they are doing with other, lenders. So it speaks to concentration risk analysis, gives you the opportunity to know concentration risk analysis, to do sector exposure monitoring, to do geographic exposure monitoring. this is what portfolio monitoring do for you. It's so important that once you have granted loan and you're trying to monitor, you should have this kind of product that speaks to ability to see what else is your customer doing, what are they doing with other, lenders in Nigeria. Where are your loans concentrated on? Even vis-a-vis the entire database that we have. And I also want to speak to CRC risk calculator, which is a predictive and AI-driven product that makes it possible to predict collection of from customers. So it speaks to predictive collection strategies. It helps you to know the customers you have already granted loan to, how risky, what do you think will happen in the next few months by them? So it's an AI-driven initiative, and it's prioritized recovery efforts. It also increased recovery rates if you use this. There are other ones that, like I said, I don't want to bore you because I want to give enough time for Mrs. Olaya to really speak to the topic at hand. But CRC has an array of products that you can use to really manage your portfolio, influenced by data collected from over 2,300 institutions across the country. And those data have been, put in various products and services that you can use. We even have market overview, which gives you an insight into your competitiveness in the country. Now, so the key takeaway for us from here is to say that data is key to lending, is key to portfolio monitoring, is key to whatever you are doing, managing risk management, managing your risk. So it should not be seen as a one-off check. Data-driven insights is so important now because it gives you opportunity to have a better, insight when you are doing loan or credit underwriting. It gives you opportunity to dictate early enough what is likely to go wrong, even for credit that we have advanced. And of course, it gives you opportunity to monitor portfolio, like I've said, in a dashboard manner to see how you are doing, how your customers are doing with other customers, how you are doing in regional geographic location, how products, concentration, capital allocation. All of these are what you can get from data that we have. And I think this is one takeaway I want you to have. I also want you to know that emerging technologies and the future of credit is in analytics. So AI, ML, these are tools that are now being used to predict what is going to happen to your customers, and they should be embraced. Some of them are predictive in nature, some are prescriptive in nature. And of course, we also have seen the opportunity of open banking and alternative data, using of alternative data that Nigeria is also promoting. We now are in the era of real-time credit decisioning, which is done through API connections. And of course, we are in the era of digital lending ecosystem. The micro lenders of this world, the fintechs of this world, I don't want to mention specific names, but we all know them. The thousands of transactions that they are doing every day. This is the way to go. So I also want to say to those of us who are lenders on the platform today that monitoring your portfolio should not be a quarterly review, should not be what you do once in a while. It should be part and parcel of what you do all the time, continuously, so that you can know the health of your portfolio. You can know where things are going wrong, and you can be very proactive in taking decisions that will make you arrest any decline or deterioration in assets. We are ready to partner with you. We continue to partner with you, and that's why we are here. And we are a third-party institution that all what we do is just provide you the information that you need in various ways, using prescriptive, using predictive, using AI and ML. and of course using open banking, tools to get you to where we think you should be. So again, I welcome you to this conversation. My job is just to say welcome and to probably whet our appetite for what we are going to see today. Thank you so much for having me. Good morning.
Thank you very much, Amiable MD, Dr. Tunde Popola. Thank you for this introductory remark. We appreciate you, as always. At this junction, I want to invite our guest speaker, that's Mrs. Oluwatoyin Olaiya, the Executive Director, Risk and Compliance at First City Monument Bank, for our presentation. You're welcome, ma'am.
Good morning, everyone. All protocols observed. I want to thank the leadership and management of CRC Credit Bureau for organizing this webinar and for inviting me to speak on this important topic. So I welcome everyone. The theme is quite apt and relevant considering the external headwinds impacting the credit portfolio of banks globally and in Nigeria. Credit portfolio management is becoming increasingly complex. Data analytics remains a major scalable solution to rising NPLs, regulatory pressure, and macro volatility. So looking at today's agenda, I have 30 minutes to go through my presentation. So I will dwell on major points, and hopefully by the end of the session, we should have covered an overview, as it were, of the topic. I won't dwell too much on this slide. It's just looking at the Nigerian banking credit landscape. I'm just highlighting the regulatory expectations regarding asset quality compliance and risk management. So we're seeing increasing credit growth by banks across target sectors. So this implies greater risk exposure to defaults if not managed. Industry NPLs closed 2025 around 7%, and the central bank expects banks to stay within the 5% NPL ratio. So the key question is, how can banks achieve this? Employing data analytics at both the appraisal and portfolio levels is an advantage. But for this session, we'll be looking mainly, at portfolio risk management, not necessarily the appraisal, part of credit risk. So my presentation this morning will be focusing on the theme. The theme, is looking at improving portfolio performance through, data-driven insights. So I'll be focusing a lot more on the credit portfolio at that level. So the most important thing is the division of credit risk. So considering our theme, improving credit portfolio performance through data-driven insights. So it's important to lay the foundation, and then, we begin to build on it. Every financial institution should understand the two perspectives of credit risk. So if you look at this slide, overall credit risk is divided into two categories. So you have the borrower or obligor credit risk. So at the point of appraising the credit, so a borrower comes, so the relationship manager appraises at the first line of defense. It comes to credit underwriting, credit analysis. So they're looking at that borrower and assessing the creditworthiness of that borrower. So that is the first aspect of credit risk at the transaction at the obligor level. There is another aspect of credit risk which we're going to be speaking to this morning. That is the portfolio credit risk, where you're looking at the entire credit portfolio of an institution, of a bank, of a financial institution, where you're looking at exposure to a group of borrowers that are in different buckets, in different categories. So we're going to be looking at that. The reason why I brought up this slide is that I've observed that a lot of institutions actually dwell more on the transaction side, the obligor side of credit risk. And though, they have portfolio loan monitoring departments, but I have seen that a lot of institutions do not focus more on the portfolio credit risk side. So it's important, that at the discussion today, we'll focus mainly on credit risk at the portfolio level and how to leverage data to minimize delinquency within the credit portfolio. So like I said, a lot of banks focus on credit risk at the obligor level, pay less attention to credit portfolio management. But the truth of the matter is that individual obligors may appear to be performing on a silo basis, whereas metrics and trends about industries, geography, or segments in which they sit are predicting future distress. So I'm going to get to that, because I was, thinking and reflecting about that thing. How do we improve credit portfolio performance? Leveraging on data-driven insights. So really, it's about it. And I want to thank CRC for bringing this up. Portfolio risk management is an aspect of credit risk management that I focus a lot on. In the institutions where I've worked and I've had the opportunity to oversee risk management, I try and emphasize the portfolio aspect of credit risk management. And we're going to be, seeing a lot of that, as we continue. So this particular slide speaks, to the previous slide as well, but now going into some level of detail, okay? So you can see there that this slide has actually broken down what I said. At the transaction level, there are certain metrics we use to assess the creditworthiness of a borrower. So you can see that transaction credit risk attributes, you're estimating probability of default, you're estimating the loss given default, you're arriving at the exposure at default. So these are some of the terminologies that the Basel II Accord encourages us to use when we're assessing credits, and also IFRS 9. So the long and short is, at that borrower level, you're trying to assess the creditworthiness, the 5 C's of credit. Can this borrower repay this loan? You're looking at the tenor, you're looking at, facility risk parameters and all of that. But at the end of the day, so if you have 10 borrowers, one is applying for overdraft, one is applying for term loan, one is applying for a short tenor facility, maybe 12 months, one is asking for 3 years, different types of facility types. At the end of the day, maybe out of the 10, 8 pass through your approval process, approved, in that particular bank or financial institution. And then they meet, what you call conditions precedent to draw down. They go through the credit administration process. So at the end of the day, maybe out of the 8, 6 meet the requirements, because approval does not necessarily mean disbursement, because there are other mitigants you put into place, collateral requirements and all that. So let's assume that 60% meets the criteria for disbursement. So all those loans are now disbursed. So where do they flow into? They flow into the portfolio. So the one you granted 10 million, that is SME, the one you granted 100 million, that it's corporate or, commercial, the one that you granted, maybe a company that granted 10 billion. So you can see the 10 billion, the 100 million, the 2 million, it could be consumer, it could be, auto loan. All of this flow into the portfolio. But you agree with me that the risks are different. The risk, of a consumer loan is different, from a corporate loan, from commercial, from SME. Their risk profiles are different, but they are not flowing into that portfolio. So you can see now, so at the transaction level, yes. And because they are all operating in different segments, some in different geographies, you may be lending someone in Kano, someone in Southeast. So at the portfolio level, you now have different buckets of obligors that are in different segments, different sectors, different industries. And these industries are operating based on unique attributes and risks. The risk that a borrower that is into real estate, the risk is different from a borrower that is within, the foods and beverages. Is different, if I'm lending to someone in manufacturing. So there are different risk profiles. So you now find out that a credit portfolio has different obligors operating in different markets, faced with different risks. And because we're looking at improving credit portfolio performance, that in itself is speaking to the health of the credit portfolio. And we're beginning to look at those parameters. But, just looking at this slide, this is just the graphical, pictorial, presentation, confirming what I just said. So we'll be, looking more at the downward part of this slide, portfolio credit risk attributes. So I just took time to explain what happens, when you're lending and they are flowing into the portfolio. So what is credit portfolio performance? So we've done, if you look at this slide, the credit portfolio performance refers to the overall health, profitability, quality, and risk profile of a lender's loan book, measured across time to determine sustainability and resilience. So how do we leverage data to improve credit portfolio health and quality? So how do we leverage data? If you look at these key performance indicators, so this is basically the scorecard of a healthy portfolio. So I already gave that background. So different borrowers, different obligors flowing into the portfolio. So the portfolio is like a pool of the various borrowers, that the FI, the financial institution or the bank, has actually lent to. But at the end of the day, so whether it's the regulator, so whether, investors or analysts, external rating agencies, at the end of the day, when they're looking at the health of the bank's credit portfolio, it is at the portfolio level. So they're looking at metrics like the non-performing loans ratio. They may not necessarily, yes, they might ask for the top 100, but at the end of the day, is the portfolio. So what's the NPL ratio? What's the portfolio at risk? Then they do the trend analysis. They're looking at the cost of risk. They're looking at the staging, which ones are in stage 1, stage 2, stage 3. What has been the impairment charges? So at the portfolio level, there are certain metrics that will speak to the health. And at this webinar, we're looking at the performance of the credit portfolio. So these are some of the key performance indicators, that any bank or financial institution that is into lending, should take cognizance of. So the non-performing ratio is key. We need to monitor and closely track all of these asset quality KPIs on a consistent basis, with the aim of keeping them within prudential and risk appetite limits. So why did I say that? Every organization is expected to define its risk appetite, meaning the level of risk that that bank or financial institution is willing to take to meet its objectives. Once that is defined, that also has to be within prudential limits as well. So for some organizations, CCBN has said 5%. Some banks might say, you know what, I don't even have appetite for my NPL ratio to be at the regulatory limit. My appetite is 2%. Some even drill down and come up with differentiated appetites. They might say, you know what, my strategy is to focus on SME. They're typically high risk. So I can have a differentiated loss number across various portfolios. So within that credit portfolio, I might say, I'm willing to take higher levels of risk with SME. My NPL ratio, I can tolerate 8%. Corporate banking, 1%. So at the end of the day, the aggregate is still the 3 or the 5. But the most important thing is that these are the basic metrics that would speak to us as to the health. If NPL ratios are double digits, that is telling you there's a problem in that portfolio. And if it is not addressed, it could lead to losses. I'll still get to that. So this slide is just to, and I'm sure most of us on this call were aware, because I know there are risk managers on this call. These are some of the things, we track. So it's just looking at, bird's eye view of that. So I'll quickly move on, to the next slide. So why this webinar? Why does credit portfolio performance, why does it matter? It matters. So why? The stakes are high. When the credit portfolio, if it is significantly impaired, the stakes are very high. Not the thing, improving credit portfolio performance. Nigerian banks with NPL ratios above 5%, they face regulatory scrutiny. And then if your NPL ratios are double digits, the bank could face dividend restrictions and other prudential actions. So ensuring the good health of the credit portfolio therefore matters for any bank. The failure of many banks and financial institutions across the world has often been traced to poor credit portfolios, ultimately leading to solvency distress, negative shareholders' funds. It is therefore, of utmost importance that banks implement measures and strategies to ensure health and good asset quality in the portfolio. And this can be done by leveraging on data to improve credit portfolio performance. So if you look at this slide, it's just the argument as to why, because somebody might say, why? I mean, if my individual obligo have established the credit worthiness, so why are you speaking to the portfolio? So if you go back, but because of our time, we can't go into all that. Global financial crisis, we all know about the subprime mortgage loans and all of that. We're still going to speak to concentration risk as one of the major risks that could negatively impact credit portfolio performance, irrespective of that individual obligo's credit worthiness. So, in a nutshell, why credit portfolio performance matters, if you look at for the FI, you can see there, if the credit portfolio is healthy, meaning that asset quality is rated good, you're within all the risk appetite and prudential ratios. What does it mean? It means that ECL, we're talking about impairment charges, are moderated and low, so means higher profitability and long-term sustainability. Stability for that FI, capital preservation and adequacy, regulatory compliance, investor confidence. You're talking about credit ratings, so you can see what happens if the credit portfolio is adjudged to be healthy. But on the flip side, if that credit portfolio has been assessed by both internal and external parties and has been rated poor, so what does that mean? And we're all aware of that. Higher provisions, higher ECL charges, erosion of capital, erosion of profitability. And sometimes, if it's really high, it could trigger some prudential actions by the regulators. They might enforce, no lending, restrictions on dividends, and sometimes, they could also call, the board and management, to action, which is a place, a lot of organizations will not want to be, So it still underscores, why we're having this session, that it's important that we ensure the health of the portfolio. So now, characteristics of a diverse loan portfolio. Now, one of the mitigants, to heightened credit portfolio risk is actually diversification. It's done a lot with equity portfolios, but we're looking at credit here. It has been found, even by research globally, that if your credit portfolio is exposed to high levels of concentration risk, and it has been proved that it leads ultimately to defaults and losses. And the mitigant to that is diversification. So it's a key takeaway from this webinar that to ensure sustainability and maintain the health of the credit portfolio, it's important that we put into place, mechanisms to ensure that the loan book is diverse. Remember the analogy I made? So you have, someone in manufacturing, different borrowers that come and then you're lending. At the transaction level, that RM that is booking in a particular branch does not have the view, of the portfolio. He wants to meet his target. But those that are saddled with the responsibility of portfolio monitoring, either in second line or risk, wherever they sit in the organization, they have that view. The individual in the branch just knows, I'm booking this loan, it's good. But those that have that view, and a lot of banks have put that structure in place. They're looking at the portfolio and they're already seeing, of my portfolio of 100 billion, I have 60% exposure to SMEs. I have 10% exposure to corporate loans. I have 5% to consumer. And then they can also analyze that portfolio by sector as well. I've spoken to business segments. So if you're analyzing by sector, you now begin to look at what is my concentration ratio to agri sector? What is my concentration ratio to manufacturing, to trade, to public sector? And then you can drill down. So within manufacturing, what portion has gone to healthcare? What portion has gone to pharmaceuticals? And then by the time you begin to see that, oh, my top 3 sectors account for 80%, there is concentration. The reason why concentration risk is a risk that you don't want to have, that means high levels of concentration, is because if there is a macro shock to that industry, we're talking about systematic risk. Systematic risks are external risks that your obligor or the bank does not have control over. So if there is a shock in that industry that you are maybe 70% exposed to, what it means is that irrespective of the creditworthiness of that individual borrower, the external negative headwinds affecting that sector could result in non-performing loans, could result in those companies moving into distress and then coming for restructuring. They might not be able to repay the loans. And then we're speaking to losses. And so that is why it is prudent that banks are not overly exposed. And the central bank, in a way, they've given some, so you cannot have more than 20% actually of your loan book in a particular. So they've defined limits just to manage concentration risk. So diversification of the credit portfolio remains a major mitigant to concentration risk. And how do we get that data? Concentration risk remains a major factor impacting credit portfolios negatively. So as we manage concentration ratio in the credit portfolio, we must recognize that it is a major tool in improving credit portfolio performance. I'm linking it to the theme. So how do you analyze, how do you have that view about the concentration risk in your various credit portfolios? You must analyze the credit portfolio into buckets. You can leverage on data. There are certain tools that you can deploy for banks that have data science units or engineering teams. You can work with them, let them come up, you tell them, what you want, that you want the stratification of the credit portfolio, and you give them, and you can say, I want that report every day or weekly or monthly. The most important thing is every bank must have that visibility. So analyze that credit portfolio into buckets that will bring out the concentration ratios by industry, geography, business segment, collateral, rating, products. And by the time you mine that data that is sitting in your portfolio, it becomes a rich data source for managing risk. Because what it now does, by the time those reports are generated, and you now have a view that, wow, as an institution, we have actually lent, or in this portfolio, 80% of my exposures are to oil and gas downstream, or 90% at man. And you already know, wow, manufacturing companies right now, and there are certain macroeconomic indicators that affect some industries. Some industries are more sensitive to naira devaluation, are more sensitive to exchange rate movements. It could affect their margins and subsequently affect their free cash flows and thereby impact repayment. So what that analysis of the exposure you have, and it could be that my exposure to the northern region of the country, we already know what is going on, insecurity and all that. So if you dimension the portfolio across, you could do it by collateral type that 60% of my portfolio is secured by real estate. It could even be that clean. It gives, you see, what happens is that data speaks. And that's what I tell people. By the time you mine that data, it's already telling you, hey, 80% of our portfolio collateralized by real estate. What are the legal implications? In Nigeria, what is the recovery rate? We're going to get into that. You now begin to, can I live with this risk? Have I managed documentation risk? At such a point that should there be, a reason to foreclose? And you even mine that data. What has been my experience over 5 years in recovering from this class of assets? If my recovery rate for this type of collateral over 5 years, in fact, Basel says you 7 years, is 10%. Then sometimes you might be looking at, I'm not really secured. So that's what data does. And then, so when, an obligor is going to pledge collateral, not that you won't take it, you take it, but because you already have data, you've mined the data within your organization, you already know the experience that we only recover 10%. So what it now does is now, further credit enhancers. As you're taking that collateral, there are other things that you might be strengthening. So concentration ratio, that analysis, it reveals the portfolio buckets that are vulnerable to macro headwinds by their sheer volume. So the shocks in a sector where a bank is holding 60% of its loan portfolio may prove disastrous. Like what happened? Banks, global financial crisis, or prime mortgages. Macro shocks can be disastrous, and that's the truth. So we all know what happened. We all know what happened. And in other instances, overnight, you just wake up, like what happened in devaluation. So banks that had exposures, foreign currency denominated assets, in one day, on 24 hours, things can happen. So that's why those that are saddled with credit portfolio risk management in banks have to be assisted with the right data mining, data analytics tools to ensure that they are seeing what the portfolio is seeing. They are managing concentration risk and coming up with metrics to limits. That's what we call limit management. So they are the ones that we're recommending to management, okay, aside the regulatory, limits, they are coming up and saying we should not hold more than this percentage in this sector. They've done their risk assessments. So segmentation analysis, I'm dwelling a lot on this slide because of the importance. Segmentation analysis of the portfolio is actually very important. So a one-size-fits-all monitoring approach for all of this, various buckets on the slide, it will not do. Each segment requires tailored KPIs, scorecard models, and what we call early warning indicators. How I'll monitor exposure to SMEs will be different from how I'll monitor exposures to, and within corporates, you have investment grade names, sub-investment. The way, I'll be monitoring an investment grade facility will be different because on the strength of their cash flows, I've not taken collateral. So I would have built in covenants and I'll be monitoring covenants. There's certain things but for SMEs, the way I'll be monitoring SMEs will be different. Okay, so I just wanted to mention that. So what are the key challenges in managing diverse loan portfolios? So I've spoken a lot, at concentration risk, and that the mitigant for that is actually diversification. If we're looking at market risk portfolios and equity, speaking to hedging, I know for some oil and gas transactions, we hedge exchange rate risk, So I'm not going to go into all that because there's another body of work around credit. Well, I won't say credit, portfolio management that is speaking to some other exposures around market risk, and where you're looking at some other strategies at managing those portfolios. But I'll be restricting this presentation to credit risk. So what are those challenges in managing diverse loan portfolios? So I already mentioned portfolio complexity. So I won't go into all of that, But data silos are the single biggest barrier to portfolio analytics in Nigerian banks. So I'm moving on to data challenges because I've spoken to portfolio complexity at length. So you book the loan. It has flowed into that portfolio of various borrowers that are operating in different industries across multiple geographies, and for banks, that have subsidiaries In other countries, you're looking at cross-border lending. You're dealing with sovereign risk, country risk. So that's even at the borrower level. So we're now speaking to the data. We're speaking to how data can enable you make informed decisions to minimize losses in the credit portfolio. This is really what we're discussing. Now, there's this concept of garbage in, garbage out. If the data ab initio is not clean, is not accurate, it means that the output, for instance, if at the point of disbursing the loan, the borrower is actually SME, and when it was being booked, it was booked as corporate. And let's assume that that error rate in that particular financial institution is high, meaning that at the portfolio level, those that are mining and analyzing the data will speak and say you have 60% of your loan book as corporate loans, whereas in actual fact, they're SMEs. But executive manager is going to run with inaccurate data. Oh, I have 60%. Oh, yeah, these are investment grade. Whereas that's not the truth. That is the challenge. So, poor data quality. And we've seen it. So the first step is to make sure that all banks have the data governance structure, data cleanup. It takes time, but it has to be done. If we really, really want, to move into informed decision making, leveraging on data. Another thing we've seen is siloed data. Core banking system, so has its own data or facilities booked. Then you have the CRM. So the relationship managers, they're pulling from the banking application as well to have an understanding, about their customers, when they're marketing and all that. You have data collections. So these are just examples. So each organization has its own bouquet of various applications, that they've either developed internally, or vendor procured, where you have different, data in silos. It brings about inconsistency when it comes to data definition. And then you don't have online real-time data. So, and it becomes a challenge for a lot of CROs. Because what the chief risk officer wants is that every morning, as I resume, just on a dashboard, that would have both trend and level, that would tell me within 24 hours. So maybe like a yesterday or Friday, my exposure to Southeast, I had 40% of my portfolio. This morning, a typical chief risk officer wants a dashboard that is telling me that 60% to Southeast is now 75% because certain loans were booked. But that has been the challenge. So that CRO is armed with the data and can go to the board credit committee and I'm seeing, and I'm still going to get to that. From what I'm seeing and the trend, we're increasing exposure. This is going to happen. I'm advised, so that advisory capacity, to take decisions based on data. If the data is not complete, if the data is not aggregated, so there's a concept of aggregation when it comes to credit portfolio. If it's not aggregated, then number one, it's no longer relevant. Then it's in silos. In a lot of banks, it's every month and it's no longer timely. When data and reports are not timely, they're no longer relevant because within 30 days, a lot would have moved. And what are the external challenges? I've already spoken to that. The regulatory IFRS, Basel, the volatility we're seeing, FX, inflation rate, the shocks. And right now, there's a whole lot of, digital credit offerings. That in itself introduces cyber risk. And a lot of banks are grappling with that because we are now offering some products that are not being offered via the traditional, methods of lending. It's not as if, an analyst is analyzing. Okay, so a lot of banks have deployed AI that introduces model risk. The artificial intelligence of the robot is performing the role of a credit analyst. Yes, there's a logic running. You've inbuilt the 5 C's of credit. You've come up with, scoring mechanism that is working back end, but the the truth about the matter is that that AI or that digital platform is coming up with the accept, reject, and approving. And to be honest, that must be validated, what we call back testing. It introduces model risk. And if you're not careful, because you know a lot of APIs and all of these things, man in the middle attack, cybersecurity, customer data can be hijacked. You may be lending to someone who you think you're lending to may not be. So those are some of the risks that we see. So now I typically present this slide, because I oversee typically most of the second line roles, not just credit risk. So, but credit risk is also a major second line, So for any professional that is sitting in second line of defense, let me put it that way, second line of defense is speaking to the role, so especially credit risk, that really is more into prevention. Third line, those are our friends, the auditors, whether it's your internal auditor or the external auditor or central bank. They sit in the third line. Their role is assurance. The first line are the business teams. They're the ones generating. In fact, they own the risk. They're bringing in the borrower, bringing in deposits. That is first line of defense. But for the risk manager is second line. And 80% of the role of any risk manager is actually to prevent or minimize. We cannot eliminate risk, even credit risk. And that's why even CBN says NPL ratio of 5%. So risk cannot be zero, but risk can be managed within appetite. And that is the role of the risk manager when it comes to credit portfolio performance, to minimize the incidence of delinquency, to minimize non-performing loans to a level that is within the appetite of that organization. It must be at the level that organization is saying, you know what, I'm willing to take this level to achieve my objectives. So how will data help us as second line? Meaning that my role as a risk manager is not necessarily to be investigating. It's more from the preventive. Not what has gone, not when the loan has gone bad. I tell people, when it gets to that stage, when I'm booking the loss, let me put it that way, that impairment, that is already an incident. It's already a loss. It happens, but to be honest, to improve credit portfolio performance, we must do our job as second line officers to prevent. Now, what is this slide saying? This slide is telling us that data is in 3 categories and it flows that way. Like I already explained, you have 5 borrowers or 6 borrowers. They came in, they met all the criteria, disbursement parameters, booked them, and they flowed into the credit portfolio. You know why hindsight data is 100% confident? So if I gave a company 100 million loan and he met the requirements and that is disbursed, the 100 million is disbursed into the customer's. A loan is booked, 100 million goes into the customer's account. If it's a term loan, I don't need, there is no assumption. What flows into his own, if you print the credit printout, Mr. B on that term loan, you will see 100 million. There is no dispute. So, but that is hindsight data. Hindsight data is historical data, meaning it is a past event. That's why he put a date as that when the loan was booked. Is as that. Is hindsight. There is no disputing it. It has happened. The 100 million has been booked. And many 100 millions that will make up maybe your 10 billion credit portfolio. Different buckets, 1, 2 million here, 3 million there, 100, 500 million. That now makes up that 10 billion loan book. Analyzing that loan book is actually hindsight data. That means it's the past. It's like riding a car. Now, if you're riding a car, I'm traveling from Lagos State, I'm going to Oyo State, specifically if I'm going to Ibadan. If all I'm doing is I'm looking at the rear mirror, you know that car will have accident. So you move to insights. But occasionally you'll be looking at your mirrors because I want to know who is behind me. That's the hindsight data, which is what I've spoken to. I want to know my exposures, by geopolitical zones, by industry. How much am I exposed to oil and gas? Especially when you hear in the news, hey, interest rate is going, what's my exposure to manufacturing sector? How can I begin to hedge and minimize the risk? It's hindsight data because it's already there, it's already done, it's past. But you now move, which is what this webinar is speaking to now begin to mine that data, and I've already spoken to that, which is now the insight. That insight is like the dashboard in your car, where the lights will be flashing. Maybe your tire level, the air in your tire is supposed to be 40. The car dashboard is telling you it's at 20. You know that as I'm traveling to Oyo State, that car has not had an accident. But there is a risk. So a risk does not mean that the loss has happened. But when that dashboard is flashing, that the brake oil is low, you're still seeing red light, you're still driving, accident has not happened, meaning that it's still a risk. The same way NPLs have not happened in the credit portfolio. But when I'm seeing like that dashboard, that's why I said the CRO needs those reports. That is already telling me my exposure to manufacturing is getting 17%, is now beaming. We do what we call heat maps. You put it in the red. You're telling me that my concentration ratio in an industry that is experiencing negative macro headwinds, it becomes a red. So that's the insight you're deriving from your credit portfolio. It is now data that can be used to mine. So just like that analogy, you now say, no, as I'm traveling, this car, you gauge. Make sure the air level, you gauge. Oh, make sure the brake oil is. That is risk management. I'm not waiting for that car to have bust tire. I'm not waiting. That's why I said it's preventing. And for the credit portfolio, it's the same analogy. As I'm seeing those red flags, as I'm seeing that my exposure with this collateral, my exposure in this geography, my exposure NPL ratio, in fact, the one that, if I should be the priority in terms of managing the credit portfolio, you dimension the portfolio by NPL ratio, by watch list ratio. The NPLs, meaning those ones have already gone by, it tells you, in fact, data speaks. By the time you dimension by NPL ratio, I now do a trend. I now see that NPL ratio to the exposures to manufacturing, I'm just using an analogy, is 15%. I now see that all other sectors are 2-3. That data is telling you something. It means, and they now look at the trend, and the trend is that manufacturing has been increasing, is rising. So you must always do trend and level. That data is telling you something. There's like, it's either an underwriting process, maybe the way we've been assessing creditworthiness of manufacturing or something. You now begin to do what we call root cause analysis. To now get to the root cause. Why is NPL ratio to manufacturing this high? That is now the insight. So that by the time another borrower, it may not be that borrower's fault, but the portfolio is telling you that there's something you have not gotten right in lending to the manufacturing sector. You can put a brake, and it usually causes friction. At the portfolio level, especially for the CR said, no. And further lending to manufacturing sector is under temporary suspension. I'm just giving that example. So what that data has done is giving you insights so that you can course correct, and then you can say, you know what, we've addressed these are the issues, we've done the root cause and all of that. So that's what insight does. And it gives you like 80% confidence because you've already mined the data. And then you go to foresight. So a bank can leverage on data to improve credit portfolio performance in two primary ways. And the truth of the matter is that when you're looking at your credit portfolio, a lot of times you speak to the downside risk. So the NPLs, the loan losses, but it's not only about downside risk. There's also the upside risk. I won't speak much about that at this session. Because you can actually optimize earnings. So concepts like risk-based pricing, risk-adjusted return on capital, asset securitization, credit default swaps, what happens in other jurisdictions where they are not that they're not dealing with asset quality issues, but in a way, sometimes they've been able to manage concentration risk and all of that. So They are not even, which is where we should be moving towards in Nigeria. It's just that we don't have those markets here yet. Where, you know, you just look at the balance sheet and like, it's not asset quality issues now. You're like, you know what? This particular bucket, I want to sell it. Okay, my spreads are not within. So you're looking at yields. So that's optimizing the earnings. But I'm going to focus more on the downside, looking at credit portfolio performance. So I've spoken to the key risk indicators now. The NPL ratio, the concentration ratios, I've spoken to that, expected credit loss. I've spoken to how you can mine your hindsight data, derive insights. I've already spoken to that, where you begin to know what portion are in the watch list. You know, I spoke to NPLs, but honestly, coming up with a list of buckets per sector and industry that are in the watch list, meaning, you know, they are already what we call early warning indicators. We are not supposed to wait for payment. You know, when you're already talking about past due obligations, that means there's been a payment default. You know, in a way, that's no longer risk management. You know, like I explained, it means the accident has happened. A payment failure. But we can now use data. That's where watch this from what you call early warning indicators. That means those loans that are already showing signs. And there are certain metrics that you can use. You are monitoring turnover, their cash flows. You know, they're still meeting the obligation, but already seeing a downward trend. That means you have to be placed on inquiry. You have to start asking questions, what's going on in this part? So we don't wait for past due obligations to crystallize. It's still part of insights. If you're able to dimension the portfolio in such a, I know that data is difficult, but sometimes when you put covenants in place at the point of approving the credit, it helps. And the borrower is the one even supplying the information we are asking. You want quarterly accounts, and then you're monitoring their turnover performance. When you're beginning to see deterioration, you move closer to the customer to make sure that you still ring-fence the cash flows that will repay the loan. So we need to manage downside risk a lot. So I've spoken to insight. So what is foresight? If you do your hindsight and your insight in terms of analytics very well, especially at the insight level, like I've explained, you mine the data, you have the portfolio reports, and we have reports also from the credit bureaus. CRC also has that, the portfolio, the quarterly PMI reports, where portfolios, you know, are dimensioned, and it even gives you external perspective, and we're going to get there, which is good. So have an idea of what is happening in industries by geography, and you can also dimension a portfolio by rating. You know what that does? At the end of the day, you can now say that only 20% of my portfolio is to investment grade. You now begin to dimension, most of it is to maybe speculative or sub. It gives you an idea, and then you know the risk profile of your credit portfolio because it is time and tested. So if you do your insight analysis well, using the credit portfolio and all the data analytics that I've spoken to, you're now moving to foresight. In fact, a lot of banks are still at the hindsight insight. At the insight, a lot of financial institutions are struggling. Foresight is best practice. A lot of global banks are actually at the foresight because they don't have a lot of the data challenges we have. I'm just presenting this, let us know that it can be done. It's a journey, and we should strive to move towards that, even by taking small steps. Even with the little inside data that is accurate that we have, we can begin. Foresight is speaking to allowing the insight to be done at the point of their analysis to help you make decisions. And I spoke to, you know, with that insight, the chief risk officer or those in charge of risk, even though they're not really the ones bringing in the individual, but they can leverage on that data to advise the board that this is what we're seeing. And at that level, risk management now is moving to that level where it's becoming strategic, meaning that with the data you have mined and all of that information, you can predict the performance of the sector. Yes, 40% of it, and you will state it there that I've gone through 5 years data trend of how my exposure to this particular sector has behaved. We call it default experience. And you have that data. And you can tell them that from what I've seen, I'm 40% confident that if we do not address the root cause of why we are having these losses, I'm 40% confident. And you plot it. If you go to a risk meeting and you're starting with that kind of slide, I'm 40% confident that we'll experience ECL, and you are predicting and forecasting ECL, you are forecasting NPL ratio, then risk management has moved from the report. We report, and sometimes management looks at risk management like, how are you different from internal audits? This is how risk management will begin to add value as second line, so that you quickly help to prevent by bringing in measures. It could be policy interventions. Like I said, before the accident happens, you're already telling management, hey, I'm seeing, like that dashboard, if we do this. So by the time the external auditor is coming, risk management has already ahead of time brought out the issues. And it's not just to bring it out, what we call risk mitigation, those recommendations, and ensure that they're implemented. So by the time the external auditor is coming on central bank, what they will be coming to assess is what risk management has advised, leveraging on data to improve the portfolio. I decided to dwell a lot on that slide because it's a slide, that I typically use to bring home the point about the role of second line of defense. So the foundation of credit portfolio risk management. So what are we speaking to here? What gets measured gets managed. So one of the principles of risk management is that you cannot manage what you don't know. And that's what this webinar is all about. If you're not analyzing your credit portfolio, if you really don't know where your exposures are situated, then you cannot manage that risk. And like I said, risk management is managing risk within your appetite or prudential limits, not completely eliminating, because you need, so that is the balance between risk and reward. Some levels of risk will be taken, to meet objectives, but within, prudence. So what this slide is speaking to, that foundation of credit portfolio risk management is still data. So data is not just an IT concern, it's a risk management, and that's all I've spoken to. Hindsight, insight, foresight. Okay? So for risk managers on the call, not necessarily going to purchase off the shelf. You can sit down with your data science team or your engineering team. As long as you know what you want from that credit portfolio, they can help to build those systems that will give you that data that you can leverage on to step into that advisory capacity that would help to bring down losses in the credit. We don't have to wait for these NPLs to. Let us be that voice leveraging on data. If we have robust credit analytics, we will report lower NPLs. So investment in data quality is a very high return on investment for risk management. So these are some of the things you can detect early, the warning signals I already mentioned. You can understand customer behavior. You can predict defaults at a particular confidence level. So this is also speaking to the discussion. So this is just now, what I said about hindsight, insights, and that analogy. You're driving a car, you're not always looking at the rear mirror. You do, and the two side mirrors. We're always looking ahead. You're always looking ahead. That's the foresight. So what this slide is showing us is that, how do we get to that point where we can begin to leverage on data insights to improve the health of our various credit portfolios? In a nutshell, this is the framework, and I've spoken to it. You already have internal, I mentioned hindsight. The data is there, and you can mine it. You can be as granular as you want. You can have loan performance history. You can have it by segment, by sector, by, all of that is already sitting. The information is there, And then you have external data like the credit bureau data, macro indicators. You can subscribe for those that have subsidiaries outside, the country. There are various organizations that will give you analysis of country risk, all of that. And right now, this age wherein you have ChatGPT, AI, any information you want about macro indicators, it's available at your phone. You don't even need to pay any consultant. The information is available. So internal data is available. External data it's not like before where you have to pay consultants. Sometimes the rate, it's there available. ChatGPT, AI, macro, and how you want the data, they'll even provide for you. So we have internal data, we have external data. But how do we now, bring all of this together to improve the performance of the portfolio? What I already explained, analytics into insights, okay, and then decision making. So the destination is improved portfolio performance, lower NPLs, build resilience. That means that portfolio should be resilient to those negative headwinds out there, should be resilient to the shocks. So how do you build a portfolio that is resilient? This is the framework. You start with the analytics, which I've spoken to at length: descriptive, diagnostic, predictive, prescriptive. And then you move into insights. But a lot of banks, are within analytics and insights. And that's the truth. So we're being encouraged, to begin to leverage, move into decision making, and let that voice be heard, and then ultimately improved portfolio performance. So we're all on that journey. We're all not yet there, but that's what the slide is speaking to. So types of analytics in credit portfolio management. So what happened? Why did it happen? So that's the root cause analysis. You cannot get to the descriptive, you don't mind the data, which I've spoken to. So the portfolio, I already mentioned, a lot of borrowers with different characteristics have flowed into that portfolio. So working with your data science team or your engineering department, call for the kinds of reports you want. NPL trend, portfolio concentration, delinquency in buckets, all of this. And then the diagnostic is where the real work is. So what's the root cause? Why am I seeing NPLs in these buckets? Vintage performance. So how come the loans, sometimes I tell you another, I never found out that loans that were booked within a certain period are the ones behaving. So maybe that was the time the valuation occurred. So you can actually pinpoint, what happened. Okay? So a lot of times we end at, okay, I know why this happened. And then we make provision. Or we say, hand over to recovery. Let us sell collateral. Most of the time, that the predictive side of things and the prescriptive is now where the advisory comes into play, where we now use that data to now go back to what Mr. Okola was saying about at the assessment. So even though we're looking at the portfolio, there should be a handshake between those that have the responsibility of monitoring credit portfolio or reporting with those that are doing the analysis, the credit analysts. Because even though this data is a bit historical, that has been mined, but now you have metrics, telling you this particular bucket of assets have experienced default over a certain period, or we have concentration in this, and there are macro headwinds. And then you're seeing early warning signs or early warning indicators in a particular, bucket in the portfolio. This data can now be shared with those that are assessing creditworthiness in such a way, that even though at the obligor level, they've done their typical 5C down repayments, they've done cash projections, everything is looking good. But the portfolio guys are telling them that this is what we've seen. Over the last 5 years, this particular portfolio of assets that we have lent to has experienced these default levels. Now, so in making that recommendation, the approval authority, if they have that data, that even though this obligor seems good, but our default experience in Bank A, lending to this category, I'm now going to have data-driven insights. Now, the chief risk officer or the chief credit officer can overlay and moderate. So even if the analyst is saying, oh, we've done the rating, 5 C's, everything is okay, they're ticking. When it now comes with that data, you can moderate your approval and say, this has been our experience. The probability of default. And the truth of the matter is that business will fight you, and that's why it's evidence-based. You have the default over 5 years. This has been the trend. So it is at a confidence level. You can say, you can beat your chest and say with 60% confidence. I am confident that if we do this one and add it into that bucket, it will experience the same because they're operating in the same industry, in the same macro. So you have a confidence level and you can estimate that the probability of default is this. And then if you've done your risk appetite framework very well, and that is why for the chief risk officer or those that are in second line, make sure that your credit policies and your risk acceptance criteria, your risk appetite documents are watertight. So that even where the business team, because we're talking about portfolio now, is saying this obligor should be granted this loan, you are now coming with data that the PD is beyond our tolerance. That the only person that can accept this risk is the board. So it generates that discussion. So at the end of the day, by the time those that have the responsibility for governance and approval, so they're reviewing everything, then they can take informed decision that, okay, ask for more credit enhancers. So what are you doing? So it's part of the predictive and the prescriptive. You're not prescribing. So you might not say, okay, if you want to do it, we're going to do risk-based pricing. This is the level of risk is high. So that could be the prescription. So many actions can be taken to improve the credit portfolio. So identifying portfolio trends using data, I've spoken to that. You can identify delinquency trends, sector trends, geographic trends. I know my time. I'm moderator, I don't know how long I still have. So I can really, so I've been rushing. Hello?
Okay, ma.
How many more minutes, please?
Maybe you can round off as soon as possible, ma.
Okay, my time is up.
Thank you, ma. Yes, ma.
So I've already spoken to this, the early warning indicators. I've already spoken to this, declining account turnover, missed installments. So these are some of the things, that the data, even mined properly, will bring up. So what I've spoken to data challenges in Nigeria. Data quality is an issue, but for a lot of organizations, make sure that you have a data governance framework. The cleanup is essential so that whatever we're, keying in or booking or the way and manner in which, some of the data is being captured, is such that it's presenting, information that can be used for decision making. So all of this, I already mentioned the sources, AI, ChatGPT, macro risks, sector industry risks, customer borrower risks. Information is available both internal and external. So what are the benefits? I've already spoken to that. Lower NPLs, reduced credit losses, better ECL accuracy. I've covered all of this. What are the business benefits? Improve profitability, optimize pricing, strategic benefits, enhance resilience of the portfolio. And by the time analysts, rating agencies are reviewing the portfolio, they're coming up with ratings, that are good, and that if you need, TFI inflows and all of that, it becomes easier to attract, such funds, that may be required, for the business. So what are the critical success factors? Data quality, data governance, integrated data platform. The pitfalls I've mentioned, poor data quality, over-reliance on intuition. Yes, let the data be the evidence. You need management buy-in. I believe CROs, ED rates are levels where, they can actually support, at that advisory level, and their voice is heard, And then, so this is my final slide, recommendations. So what are the 7 strategic priorities? Okay. So these will be the key takeaways for us. So it's important that we prioritize what we're doing as an organization. You can create a 90 to 180-day quick plan, for the top priorities. A lot of banks, for some, these are already priorities. For some, it's a journey, but it's important that we know where we are. Do your gap assessment. Am I monitoring the credit portfolio in line with global best practice? Do I have a view around costs? And if I have a view, what have I been doing? Have I just been reporting? As in insight, I just share portfolio reports with the board, with management, and that's the end. What we're saying here is that's not the end of the role of the second line of defense. Otherwise, you're like an auditor, okay? So that report that you're sharing is to lead you to foresight, to making recommendations to improve the health of the portfolio. So I already spoken to this, the performance of the credit portfolio is critical. Data creates visibility. It shows you the health status, of the portfolio, especially early warning indicators, so that, the earlier you deal with it, it doesn't deteriorate. So that's basically what we're saying. And then in modern credit risk management, competitive advantage belongs not to institutions with the most data, but to those that convert data into timely insights and decisive action. So I'll end with this. So that's it. So it's not just we all have data. So what are we doing with the data? What are the insights that we're getting from the data? And then most importantly, are we using the insights into decisive action? So thank you. And that's the end of my presentation.
Thank you very much, Ma. Thank you very much for this insightful presentation. Actually, I was anticipating that the presentation is going to be very loaded, because I was looking at what FCMB has done and how the different institution, regulatory bodies has recognized your effort and impact in the economy. So I know that we are going to get much more from you, and I wasn't disappointed at all, because I was looking at the CIBN award of last year, and I noticed that out of the total disbursement to the SME in the country, FCMB actually had 24% share. That is almost a quarter of what was disbursed to the SME. So when it comes to portfolio monitoring or portfolio performance monitoring, the best institution to go to is actually FCMB. Thanks so much for this insightful presentation. I appreciate you. And at this junction, we want to go to the panel section. And maybe I should take it from where you stop. I like the last quote, Ma, where you mentioned that it's not just about data, it's also how we are able to get insight from those data. I think I love that. So maybe I'll come back to you. Let me go to Mr. Isaiah Iyede, about this data. Mr. Isaiah Iyede is the head of automation at CRC Credit Bureau. So Mr. Isaiah, Madam Olaya has given us a foundation that this is not just about data, but insights we are able to derive from this data. So looking at the emerging trends in credit data and automation, what kind of data or what kind of trend should institutions be preparing for in the next few years?
Okay.
Hello, Mr. Isaiah.
Yes, Joshua, thank you very much. And I must applaud ED for her fantastic presentation. I was especially focused on the hindsight, the insight and the foresight slide. It was really insightful. And of course, it aligns with what we do in the Bureau. So to your question, so thank you very much, Madam, for your brilliant presentation. We have taken a lot of insights, as a matter of fact, from it, ma'am. So, there are so much is happening right now with data, with AI, with machine learning, all on the horizon. As a matter of fact, AI and machine learning, data analysis core is here to stay. So what should the institutions be looking at? Automations, right? So one of the things that the ED spoke about was monitoring portfolio, right? So across institutions, what we have seen is that in some, let's take a lender A, for example, you can see that in his home institution, in one institution, his loan might be performing. Across other institutions, he has loans that are in different classifications, maybe watch list, substandard, and so on and so forth. So what the institutions should now start thinking about plugging alert systems into their customers to see when my customer is moving from a performing loan to watch list in another institution, I should be able to be alerted, not just waiting for maybe a quarterly portfolio review, but should be proactive to know when a customer has moved from one bucket to another bucket. This is automation, it's here to stay. So this is one of the emerging trends. Proactively monitoring when your customer is moving from one bucket, or whether it's performing in a loan or has moved to another bucket, so that at that instance, once that happens, when you get that trigger, when you get that alert, you can spring up into action and then know how to manage that customer. So that is what I would say. I will now call that shift from monthly batch cycles, right, to continuous real-time monitoring of their customers. So that is what is, and already some of the institutions are already taking that into, already using that. And there's also open banking, right? This is not new. Most of us in the audience already know that this is an emerging trend, and especially when it comes to credit. And I think the institutions should be ready for this, right? Data is new oil. I like how the MD called it new oil, right? And once open banking is solidified in the system, right, institutions who are first to grab that opportunity will greatly benefit from it. So those are some of the things I think I should add to that.
Okay, thank you very much, Mr. Isaiah. Thank you for your insightful response to that. So I want to come to you, Mr. Oyejide. Mr. Oyejide, are you with me?
Yes, I'm with you.
It's okay. Thank you very much. Thanks for your patience, and thanks for your participation as a panelist in this webinar. So, and thanks for what you are doing at Advanced Lafayette as well, because I know Advanced Lafayette is doing a lot, and in terms of innovation, several awards in terms of innovation, banks, microfinance bank of the decade, and impact in SME, and a lot of that. So what you are doing at Advanced Lafayette is highly recognized, and we are all seeing what you are doing. So from your perspective as the Chief Risk Officer of a leading microfinance bank in Nigeria with international footprint, so what portfolio quality metrics provides the earliest indication of portfolio stress? So we are looking at the portfolio quality metrics that provide the earliest indication of portfolio stress. Do you want to share your thoughts with us on that?
All right, thank you so much, Mr. Joshua. Firstly, I want to really appreciate the MD for the opportunity to be here, and the keynote speaker for the main speaker. In fact, the presentation was loaded, really insightful. I appreciate you, ma'am. So to the question, the key metrics. Many a times when we look at portfolio deterioration, one thing that we need to understand is it doesn't happen all of a sudden. It doesn't happen suddenly. And then the metrics that, as far as I'm concerned, if, many a times in the mouth of many risk personnel, you can talk about Part 30, can talk about the non-performing loans. However, if I want to grade, I will say the first payment default rate is one key metrics that provides earliest indication of portfolio stress. What do I mean? For me, I call it early default rate. Early default rate. If a client misses, and then from the presentation of the ED, I can build on that. If a customer misses the first repayment, it should be a sign of what is to come. Then when we first started lending, we used to joke about this very matrix so well. And we tell ourselves, if you give this loan and the customer decides to put this loan, throw it under the bed, at least for the first few months, the customer should be able to pay without issues, which actually means that if you really want to ensure that you are proactive as a risk personnel, the first payment default rate should be monitored. The clients that are missing their payments, especially the first one, for me, I extend it. The first 3 repayments, if there is a late payment in the first 3 repayments, it means that there is pressure. There's likelihood of pressure coming in the future. Also, the movement of delinquency from 1 to 7 days. That's the part 1 to 7. 1 to 7 days is actually very key. I cannot wait for part 30 to determine, the stress in my portfolio, especially for microfinance institutions, microfinance bank. If I wait to part 30, the issue will have happened. And then it means there is a need to, one, have data. This is key, that one can monitor on a daily and weekly basis, not at the end of the month, to show, what is the movement of late payments in my portfolio? Not the ED already established it, not just at the level of obligor, the portfolio as a whole, at a segment level, even sometimes at branch level. What is the movement of default? From current performing loans, to 1 day late, 2 days late. Once you are able to monitor that, you will see that stress. For instance, an institution that over time, historically, the fourth repayment default rate is around 3%, and all of a sudden jump to 7%. You don't need to wait till the end of the month for you to know that something is coming, that there's possibility of stress in this area. However, there's also need to now deep dive, know the root cause, then prefer solutions. So for me, I will pick those first 2, early default rates or first payment default, as most people would like to call it, and the movements of delinquents from 1 to 7 days. Thank you.
Okay, so thank you very much, Mr. Oyedeji. Thanks for this insightful feedback on that question. So I'll still come back to you, please. I'll still come back to you. So let me go to Mrs. Olaya. Hello, ma, are you there, ma?
Yes, I'm here.
Okay, thank you very much once again for that insightful presentation. So I was looking, like I mentioned, in case a lot of people do not know, FCMB is doing well when it comes to SME. is doing very well when it comes to SME, and thanks to your team for what you are doing for the country. I was looking at the award given to you by Development Bank of Nigeria, and they said you are the best bank with the highest impact on MSMEs, assessing credit for the first time in Nigeria. So I want others to learn something from you. Maybe the other banks or smaller banks, especially the microfinance banks, there are things they need to maybe get right so that they can also grow. So that is why I was like, okay, let me ask this question: that what are the common mistakes that you've observed over time that institutions make when implementing data-driven portfolio management framework? You know, maybe there are some mistakes you have noticed over time that some of our institutions make when implementing data-driven portfolio management framework. Thank you.
Okay, thank you for that. I think a lot of organizations kind of give up because sometimes those SMEs, they typically present that they don't have audited financials. That's why you keep hearing, no, they don't have data. Okay, so sometimes when they approach the banks kind of struggle to do the assessments. And sometimes at the end of the day, it's whatever information. So you find them doing like exceptions, and the mistake is to proceed, okay, based on what the RM knows about the customer, and not, getting the right data to do the assessment. So, and that's why when I was making the presentation, I mentioned that, each organization, whether it's microfinance or bank or FI, must have their credit policy, and there must be a discipline. The risk acceptance criteria for the segment. So if you're speaking to SME, you must have a risk acceptance criteria for lending. And to come up with that risk acceptance criteria, you would have dimensioned the various risks and then also the mitigants. So for a lot of organizations, I believe they're lending without having all of these frameworks. And even if they have the frameworks, maybe they're not disciplined in following it and probably approving some of these loans based on targets and all of that. So, in FCMB, we have credit policies, we have lending frameworks, for these segments. And it's pretty clear as to what we will tolerate and, how we arrive at the accept or reject. And even if it's going to be beyond that, the exceptions policy is also a bit tight. So in a way, that borrower should meet the risk acceptance criteria of that organization. So that is on the governance side. So it's also possible that some organizations have all of that. And why are they getting it wrong? I also mentioned data quality. So maybe they're using data that is not accurate. So at the end of the day, the decision to lend may be based on faulty data. So how do you get that right? So the way that I always advise, sometimes in lending to SMEs, they don't have financials, so how do I do the scoring? So there are other ways, okay, that you can, come up with your pro forma. Maybe because of my background as an accountant, so you must be able to. The data they have, but it's not okay to proceed without any data. So with the data they have, you can arrive at that free cash. So these are some of the things that people have to learn. You can still arrive at the, if you spread financials, you'll be seeing your EBITDA, which is the proxy, you're doing your ratings. But for those that, so you would have categories. Okay, even in rating. So you have those that have audited financials by the Big Four, you have those. So even at that, the scoring is different because you already know that the risk profile of a non-Big Four auditor is different. So those are some of the things that we have built in place. So if you give me financials from an auditor that is high, there are certain things that we do to bring out the truth. So there are other information we ask for, and we derive the free cash flow in a way that will enable us access repayment capacity. So I think the key lesson is don't take information on the face of it. The big four, yes, they're in the category where, the accounts are audited by the big four. Any other information, you must subject it to your own stress testing. Let me put it that way, which is what we do. So that at the end of the day, you must have your own templates for deriving the free cash flow, have your own scoring mechanism, where you still building both qualitative and quantitative. So there's still a process. Even where they're unstructured businesses, at the end of the day, your accept reject is still based on data. But there's still work. So it's not, you understand what I'm saying? So it's not auto that customer has given us this and I just proceed. Due diligence must be done on whatever is presented. So that at the end of the day, you are still able to assess the creditworthiness. And where you're now using digital, and that's what I mentioned, even the logic. So it's still back to, you don't take, even a vendor, you still subject that logic, to review, to testing, to be sure that whatever decision of acceptor is doing is still in line, with your accept criteria. So those are my comments around that.
Thank you for that, Ma. I appreciate you. That's quite insightful. Thank you very much. So I want to come to my MD, Dr. Tunde Popola. Ma, I'm still coming back to you. Because we are learning from you and want to learn more. So, but let me go to Dr. Tunde Popola, sir. So I'm looking at what you have done. You've been interacting with different stakeholders for almost 17 years when it comes to data, credit data. And not only that, you were involved in the bank verification numbers introduction in Nigeria. And also you are the chairman or co-chairman of African Credit Information Sharing Association, and you sit on the as the MD of the largest credit bureau in Africa. So you've been interacting with a whole lot, both locally in Africa and internationally. So the way things are going in terms of digital revolution, I need you to advise us that in looking ahead, what trend you believe, sir, which shape credit portfolio management over the next few years, maybe in 5 years' time? What trend do you think will shape credit portfolio management, sir?
All right, thank you so much. Thank you. And I think I must thank all the speakers, especially our keynote speaker, for the nuggets that she has given us today. It's really very, very insightful. I also like the perspective brought by the CRO of Lafayette and the head of automation from CRC. So we are now at an era where it's important for every organization, even from the speeches that I've listened to today, that data will be the drivers of whatever we do at various lending institutions today and tomorrow. You see, there's no running away from it. You need insight to be able to have the foresight, to just so I can borrow from Zolaya's terminology of hindsight, insight, and foresight. Any organization that will be there in the future, that will be profitable, will be sustainably profitable, that will have high quality of portfolio, that will have balanced portfolio, like she said, will have to be driven by data. So, but that data is not just credit data alone. And that's the issue that I want us to take away from here. We now have series of data, some in silos, some now with the bureaus. Those data will have to be harnessed. We have to ensure they are available. We have to ensure that they are informed, that they can be used, from which sense can be made out of whatever we have. And that's where CRC sits on this. Now, we have an array of credit data from diverse business segment or lending segments, not just commercial banks or microfinance or fintech, but even from cooperatives, from all other institutions that have some level of lending. They also have alternative data, okay, telco data, electricity utility utilization data. All of that are also coming into play. Now, when you have all this data and you are armed with AI and machine learning, just like Isaiah said, you have the world at your step to use data for informed decision making. So how do you use it? What insight can you get from there? These are questions you must be able to answer, either by coming through the bureau system or by developing your own internal algorithm and solutions that will help you to, unveil what is masked by that plethora of data and information at your disposal. Isolaya mentioned something that even for SMEs that are perceived not to have audited account, all of that, there's a way to go around this. This is what it's all about. There's data everywhere. Some are very highly okay. Some are just dumb. Some are so not all right at all. But you use of AI, your use of ML, machine learning, can help to flush out and to bring out the best in all of those data and bring them together in a way that makes sense, that can help you to now do your capital allocation, that can help to now have trend analysis, that can help you to determine futuristically the capacity of these obligors to be able to borrow or to take on additional credit. So back to your question, it's all about data. It's all about being truthful to the quality of data that you have. It's all about being able to clean them. And it's all about being able to leverage on the tools that are available using AI. That's the perspective that I see. From us at CRC, we now have leverage. We have account aggregator platform that even financial statement analysis, we can help to really analyze. We have a product called CRC 360 that combines financial statement analysis, that combines credit score, that combines return check, and then combined with credit information report, all in one. So that you have some level of it's like a dashboard of what can happen. And this is just the beginning. As things evolve, more and more tools are being deployed using AI to get more insight from the data that we have. And finally, you mentioned my role on BVN and all of that. Yes, now you can see even the NIMC Act has just been signed, and a new NIMC Act is making NIM to become very mandatory, even for consumers. This is the future, where everybody become a number, not just names anymore. With your number, you can access anything. And so organizations that will be able to deploy tools that can use those numbers to identify critical, potential borrowers and be able to separate those that are bad from those that are good will be the one that at the end of the day have sustainable businesses. Thank you.
Okay, thank you very much, sir, my MD. Thank you very much. So before we go to the question, we have a question and we need to round up because of time. But before we do that, I want to invite other panelists, Mrs. Olaya, Mr. Jide, and Mr. Isaiah, to come up for a group photograph before we begin to wind down.
So as we are doing that, you have to find a way for us to be rounding up.
Yes.
It's our culture to ensure that we don't go beyond. So maximum the next 5 minutes, let's see, we are out of this place. So that's
okay.
So I won't say Ms. Olaya. Yeah, thank you so much. Yes.
Okay. Thank you very much.
I think Ms. Olaya, you can come up, you can have more visibility. Yes, yeah, exactly. Fantastic. Thank you. All right.
Okay. Thank you very much, Ma. So my last question before I call on my MD to give the final remark goes to Ms. Solaya. Someone is asking, how do we start with analytics? You spoke at length on analytics. So the person is asking, how do we start with analytics? Thank you very much, Ma.
Okay, thank you for that question. So you start by the analysis, either with Excel, which a lot of people have moved away from, to now mining the data. If you have a data science team or engineering or IT department, they can now build the solutions, but you have to go to them with what the data that you want extracted. There are off-the-shelf, applications that can do it. So there is a whole bouquet of resources, but you can even start where you are. If you have knowledgeable people, you first of all start with the credit printout. If it's a bank that already has all of the information, and then you now layer on that by doing the analysis yourself if you're good with Excel. If not, you can go to your IT department. Like as we mentioned, a lot of banks have now deployed, we have teams, where they're using AI. You just tell them, what you want, and they're using artificial intelligence, and, within seconds, they're already generating the data. So to start analysis, that's how you start. But you start with the credit portfolio itself, the base reports that comes from the core banking. So I believe the person that is speaking works in the bank. So there must be a report, first of all, of that portfolio that comes from the core banking application. Then from that report, you now begin to mine and to spool, but you have to determine what you want. Because those in tech, they're not risk managers. They'll tell you, what do you want? Then, between the two teams, or you buy off the shelf. But I prefer you come up with what you want. Once you get it right, then when you now buy off the shelf, you are the ones driving. Because if you just go straight to buy off the shelf solutions, sometimes the implementation may not give you what you want. But if you already know what you want, you sit down with your engineering or the data science team in your organization, and then the back and forth until they get it right. And then you're getting there. So you start with the analysis yourself. So that's the major, you start. But if you need help, like Mr. Okola has said, you can always approach Credit CRC. They've already done that work. So you can actually, what they call outsource. If you don't have the skills in-house, you can, with consultants and CRCs there, they already even have it, they have your data. All you need to do is purchase maybe as a subscription fee. So that gives you baseline. Then you can look at what CRC is offering, and then you can add to it, I want more insights. They also have a tech team. If you believe you don't have the resources in-house, why not leverage on what CRC already has in place? So that gives you a baseline. And then you can now, work with them. Oh, I want this added. That's even easier if you believe you don't have the resources, in the organization, either in the risk or tech team. Outsourcing, to be honest, sometimes it allows you to close the gap faster. Yeah. So that would be my recommendation. Thank you.
Thank you very much, Ma. So on this note, we'll be inviting the MD to give a final or closing remark. I want to thank everyone, all the attendees and the speakers. But before I call on my MD to do that, I want to inform us that anything that has to do with credit, you need information, you have a challenge with portfolio monitoring, and you need assistance, please reach out to us at CRC Credit Bureau. We are the go-to person, the largest in Africa, and we are the best. And also follow us on our social media handles on Instagram, Facebook, X. And you can also reach out to us at our office, 26 Makati Street, Onikon, Lagos. And we also have a standalone financial education center, a training arm dedicated to serving the financial institutions. We have different kinds of trainings on risk, compliance, loan recovery, underwriting, then soft skills too, leadership, management, and even marketing. So you can reach out to us, send us an email or call us. Our numbers on our website. Thank you very much, everyone. Thank you. I want to call on my MD for the final, our closing remark. Thank you.
Thank you so much, Joshua. Thank you for a beautiful job. Let me start on a note. In fact, says Olaya has done my job for me the way she concluded in her concluding remarks. She's done much for us in CRC. She was a director. So once a director, always a director. So we really want to say a big thank you today. So I mean, we've come to the end. Today we focus on improving credit portfolio performance through data-driven insights. So it's all about data today. And like I said before, this is not just the beginning. This is the core of what is going to drive business, especially lending in the future. We have, as CLC, built so big a database, and it keep on increasing every day. And we've come up with an array of portfolio, of products that we think can help you. But what makes it even more interesting is that for personalized or customized information, just like Mr. Olaya said, you can come to us. Yes, we have products, like almost 20 of them, that support all the 4 pillars of lending. But if there are specifics that is very specific to you as an institution, this is what we also like, we enjoy to do so much. We have dedicated team in-house in software application, in data mining, data engineering, statisticians, operations researchers who help that can do this for you. You can't know it more than the experts. Once we know what the issues are, we can always help you to do that. I also in particular want to mention the issue around portfolio monitoring. Most institutions in Nigeria today are not really maximizing the benefits and the robustness of these particular products. Even though the central bank made it compulsory for licensed financial institutions to use this product on a quarterly basis, some are still not doing that fully, and some are not even doing it at all. But beyond regulation, regulatory induced usage, the value proposition of portfolio monitoring addresses quite a lot of issues mentioned by Mr. Olaya today. Is it about industry stratification? Is it about business segmentation of your portfolio? Is it about geographical segmentation of your portfolio? Is it about who is doing what with your customers? Name it. That product is so robust that I want to recommend it again for everyone. We have some institutions who use who dimension some of their customers. They may say, oh, only 5% of my customers represent 10% of the value of the loan. Therefore, they focus on those 5%. That may not speak to the truth of the whole picture, because the customer that's not doing with you or have very low level of loan with you may actually be doing big things somewhere else. And that can be an information for you that you should leverage on. That's why we always recommend that it's good for you to subject the entire portfolio to monitoring and not just a segment of it. So, and I think I want to end on that because of time. Let me thank my keynote speaker today, Mrs. Toyin Olaya. I'm so grateful to you. Thank you so much for the insight you have brought to this today. With what you have done for us today, we'll come back to you because we can see that there's a lot that the industry needs to learn from your very deep and experience you have gathered over decades. Mr. Yetunde, thank you so much, Mr. Yetunde of Lafayette. You brought the perspective of the micro lenders to this webinar today, and we are so grateful to you. And of course, my colleague Isaiah Yede, who leads that team that day and night work to think out what else can we do with the data, array of data, huge data that we have. And every day they come up with something new. This is the team that can help you, you lending institutions, if you need help on how to use our data, or how even to use your own data, or how to leverage on information that can help you to navigate some of the challenges of managing your portfolio. Finally, our MC has done a lot of good job today, and I want to thank you so much for that brilliant coordination. We have some people who have worked behind the scene, Olawi Aovisayo is a fantastic guy in terms of making sure that this goes on seamlessly. And of course, our ED, Jalilat Karim, who also has been instrumental to ensuring that this thing come up successfully today. To all of you participants, we are very grateful. We hope this 2 hours is worth all the while for you. Please be on the lookout for our next edition of webinar 18.0, which will happen in the next 2 months by God's grace. This particular one, I think, will be made available in YouTube. The presentation slide will also be made available one way or the other. And of course, you'll begin to see the stories around them. But please feel free to come back to us so that we can do more with you. Thank you. God bless you. Bye-bye.
Goodbye, everyone. Bye.